getting towards the end of the summer and deep into the third quarter. This is indeed the month when OPEC Plus once again increases their supply by an announced 400,000 barrels per day per month, starting in August. We saw oil prices close out July for the fourth month of the row higher. Let's kick off this morning with Mike Muller, head of Vitol Asia. We haven't had Mike's voice on the OPEC Plus agreement yet and really would welcome that. Mike, since the deal was finally done, prices did drop off initially, but they've sort of had a steady recovery from that 68 handle on Brent, now back up above 76 at the close on Friday. Your thoughts on the OPEC Plus and its impact and the momentum now we're seeing in the oil market?
Yes, I think 2 weeks back on a Monday, we saw a 10% retracement from the highs 2 weeks prior to that, so at the very beginning of July. And now we're pretty much back only a couple of dollars off the highs of the move that we saw in early July. So month on month, I think we've had 4 months in a row now where the oil price has closed higher than it ended, even taking into account the fact that you lose the front month as it rolls, as the front Brent month obviously rolls, and there's about 80, 90 cents a barrel per month backwardation there. So all in all, yes, there was a consensus, I think, post facto, and it's easy with the benefit of hindsight to say that oil probably overdid it a little on what was a wider reflation move, or unwind of the reflation trade move, I beg your pardon. And as such, fundamentals have taken hold again, because much of the debate really centered on what happens in the second, third and fourth quarters of 2022, which in a sense don't really affect supply and demand now. And the other factor that was cited as an ingredient for that drop was concerns over Delta getting out of hand. We now have another 2 weeks worth of benefit of hindsight there. And whilst it is still taking many lives, tragically, and certainly far from over, the world is beginning to splinter into two camps, if you like. Those that are practicing suppression tactics and looking for zero deaths, such as Singapore, and as a consequence, paying a heavy economic price in keeping their borders shut, and the commensurate impact that has on things like trade. And then other economies which are letting it run. And the whole world is watching the social experiment, if you like, in the UK right now, where just before we went on air, Sean, you were observing that the case count has actually turned for the better. And it was kind of predictable that the same would happen in the US, where the US had a daily case count of more than 100,000, having come from teens or something just a couple of weeks prior to that. But as I see it, the OPEC cohesion was restored, despite the adding of 1.63 million barrels per day of baseline revision, which basically came at the expense, if you consider percentages in the pie, at the expense of those who can't produce more anyway, African OPEC, etc. And that is going to play out end of next year. And between now and then, a lot of other things are much more important to oil price, in my opinion, than the redrawing of the baseline. So there obviously was a victory taken away by those who wanted to redraw the baseline, initiated, of course, by the UAE. But it's much more important to me whether people have got it right in their assumption of when Iranian oil will return to the market. And there've been a couple of plots and subterfuge incidents there in recent days, which we can talk about shortly. The other one, of course, is how will demand shape up in a world that's rebounding from the pandemic? And finally, what does non-OPEC supply look like? So those are the three questions I think are more important for now.
Okay. Christof Rühl, Senior Research Scholar, Center on Global Energy Policy at Columbia University. Christof, thank you and welcome back. A regular anchor on Sundays for the Week in Review. And on the Week in Review, Christof, we did see the GDP numbers for the US come out at the end of last week for the second quarter. Still very strong at 6.5%, but less than was expected or forecasted ultimately at 8%. There seem to be bottlenecks in supply chain restraining that growth. Your thoughts on those GDP numbers and the Fed statement last week vis-a-vis outlook?
I think now we are in a position for the first time in a long time that we see some sort of rough trajectories ahead, because we have now recent GDP numbers, also Friday preliminary numbers from the European Union, from the US, as you said last week, and also some at least purchasing power indexes and expectation indices from China. So if you put those together, so let me start by probably just reminding everyone that these three big economic blocks start from very different initial positions. In the US, we had a severe decline, almost 4%, I think, in 2020, which now is being compensated for. China never had a decline, just growth slowed down in the wake of the pandemic. So the US is now back to 2019 levels, but for China, this is not an argument which makes any sense. So they're waiting to go back to old growth rates, which are different. And Europe had a double dip, so they declined in 2020 and then again at the turn of the 2020-2021 year. And now what we are seeing is, as you said, in the US, what I would consider strong growth, 6.5% or so, a little lower than expectations, but it is exactly like you said. The gap is made up by bottlenecks. So there are inventory numbers which are slower than expected because companies find it hard to refill inventories in the face of very strong consumer demand. And most importantly, there's an almost 10% dip in housing, and that's not for lack of demand, that's just for lack of new supplies coming on the market. The market is just bought up. And so that explains the difference to expectations. But this number is still, number one, means that the US is now back to pre-pandemic levels, and number two means that it is very close to achieving the projected growth rate for the year by the Fed of 7% for 2021. And number three, that implies, and we see this in the inflation numbers, inflationary pressure becoming pretty obvious. We have hourly wage growth now 3.5%, just published. We had a few weeks ago inflation numbers for June at 5.4%. So certainly that's the flash in the point movement which is there. Europe also has surprised growth-wise on the upside, but in the US we're talking 6.5%. In Europe we're still talking this massive Chinese-like rebound of 14% or so compared to what happened last year, because the recession was so deep. When you look at it quarter by quarter, Europe is more in a 2% range, so it's crawling out of the hole, but isn't out yet compared to the US, and it's crawling very slowly and unevenly. And China, finally, all the numbers come in as a negative surprise. So this hunch, which we had here several Sundays, that something is amiss in China is confirmed. Purchasing power indices are now close to 50%. Below 50% would actually be an indicator of an expected recession. Export orders and service orders are all below expectations and all close to bad times. And the growth rate in China also probably coming in way below, when you can trust the numbers, the 6.5%, which was already low in historical contrast to which they expired. So if you step back now, you take the long-term picture, then we are before the flash in the pan in Europe, if it ever comes, it's also with low inflation numbers, we're having the flash in the pan in the US with open question whether that will result in higher sustainable growth. That's the big question for all three of them. And we're having the Chinese experience with China, we are way ahead of the others, not having these higher sustainable growth rates or pre-pandemic growth rates. And keep in mind that everybody actually, the Fed is doing what it's doing, the ECB is doing what it's doing. They all look at the long-term growth rate before the recession, 2008, 2009, and how it dipped after that. And now they're looking at the long-term growth rate after 2020, after the pandemic, and trying to avoid a further flattening, which would bring us in a range of 1 or 2%. And it looks as if this is a hard thing to accomplish.
It's in some ways a oversensitivity to the performance coming out of 08, 09, that they're, at least in the US, allowing the inflation rate to move without challenge. Let's just go to the point that Mike made in terms of non-OPEC plus production coming back. I was quite intrigued, Mike. All the majors obviously had very positive numbers basically on the back of the oil price, but noting ExxonMobil had a 2% decline in total production, but a 34% rise in Permian Basin production, up to 400,000 barrels a day during the second quarter. Your thoughts on as you say, that could be a big indicator or a big impact going forward, non-OPEC plus production?
Yeah, I think when you take the oil majors, even in the fast reaction time basins like shale, you're seeing a manifestation of investment decisions taken many quarters, if not many years back. So it's not the sort of on the trigger type stuff, even for the oil majors in places like the Permian. So I wouldn't read too much into those two statistics out of ExxonMobil.
Okay.
Yes, on the whole, the oil majors have all posted much better results for their shareholders as a result of higher oil prices and much improved margins, and better gas prices also. So I mean, figures way better than the previous quarter. But that was kind of to be expected. No huge surprise there. As for non-OPEC oil, obviously, we have some base load that's coming in anyway. We have Johan Sverdrup's phase 2, but that's not until next year. We have more coming out of Brazil, most of it next year. We have more from the Liza project in Latin America, again later. The big one is what's going to happen with onshore North America. And we keep talking about the rig count there, and I have it up in front of me, thanks to your little link that you sent to all your readers. And I mean, the Permian is still sitting at 242, oil rigs, when it was sitting at close to or above 400. And as for total North America, 385 in oil service. Before the pandemic, we were at 600 plus, and at the peak in 2018, we were close to 900. So it is taking, the uptake in these rigs is at a snail's pace as people seem to be more considered. Now, a lot of people are saying, don't worry, wait about it, because surely at $70 WTI, it makes a lot of sense for you to start drilling fast. Yes, I mean, as some people say, the oil will follow the money in that case. But it does seem a lot more lethargic than I would have expected, given how long we've already been at or around $70 WTI.
Would you be more, Mike, sorry, Christof, you wanted to jump in?
No, I just would say the figures still, he's right, it's crawling upwards rather than jumping and running and so. But at the same time, don't forget this is a period of consolidation, probably not only of a financial nature, but what you saw in Exxon was the results of, as Mike said, previous investment and now increases in efficiency. Right? So it will come back, and figures look to me still as if the bulk of it will come back by the first quarter of next year with a 6-month delay from rig count to production, but it might come back with higher productivity. And then be around for longer at these prices, plus the possibility of hedging, plus the increased efficiency, which we're likely to see. So I will not count it out, Shreya.
Mike, you were going to mention another supply. Obviously, the Iranian barrels coming back or not, as it would be appear at least this year. Libya have indicated the potential to raise production a little bit. Venezuela seemed to be trying to crawl out of the hole itself. Do you see any of those players being a factor for the rest of this year?
Increasingly, I don't, as the year ticks on. Of course, time is a big part of that. You saw outgoing President Rouhani in Iran make some statements that seemed a little remorseful, that the window of opportunity was there to return to the JCPOA and remove sanctions. But then it's easy for him to say that as he's now on the way out. But he said, I think he said the playing field wasn't in place or something like that. The views have never been more divided, I don't think, amongst the commentators in the market as to how much Permian and how much US shale will be back this time next year. And it's hundreds of thousands of barrels a day of difference, right? The same goes for demand projections and various outcomes and scenarios on COVID-linked shutdowns. And the same applies also for what we're talking about here with Venezuela and Libya, etc. But on those, I think it's a little bit less uncertain than on Iran. I think the number of people that think we'll have substantial amount of Iranian oil coming back by the beginning of the fourth quarter this year is diminishing. And yet, because of the lag in how these forecasts gets put out, I think most commentators still have balances that show Iranian oil back in the market in Q4 this year. So it's all in the hands of the two negotiating sides. But if you look at the rhetoric on the US side about not wanting to back down and possibly imposing tougher sanction, which has been woefully amiss actually in terms of clamping down on streams getting into the global marketplace anyway. And on the other side of things, these as of yesterday, unattributed drone attacks on that Israeli flagship, the Mercer Street, off the coast of Oman, which was in ballast back from East Africa, and I believe on time charter to a large Gulf oil company. That is not conducive to a rapid return of negotiations and oil back in the market. And if you want to be a pure tactician and take away from this and be totally unbiased, if you were the supreme leader in Iran, would you not wait until you're a little closer to having a capability that the world wants to negotiate with you about, because that gives you a stronger hand? So again, perhaps if the economy is not creaking dreadfully, maybe you do wait. That said, there's a lot of talk around how the real COVID stats in Iran might be really, really bad and how there might not be money out there. There was anecdotally a comment that Firaudun Fesharaki shared with me when I had a chat with him recently, and he knows a fair bit about Iran, that, they hadn't paid their dues at the United Nations. And had so that, if that's any indication, I'm not sure that's something that's, don't quote me on it, that came from Firaudun.
Clearly. Christof, on the point, on the point, Christof, welcome your thoughts on the escalation of the Iran issue. Clearly, this incident on the weekend was quite pronounced in the fact that there was 2 deaths as a result of this attack, which is sort of the first time that this tit for tat thing that's been going on. We all assume that the actors are Iran, Israel, and others perhaps. Obviously, we do have reports in Iran of attacks on their nuclear infrastructure that seem to be continuous, whether it be attacking individuals or infrastructure. This does feel like there's an escalation a little bit because of the deaths, but maybe that was just an accident. Your thoughts on the overall of this skirmish, this proxy battle in the Gulf between big actors?
So don't forget that so far Iran has not sort of admitted to that.
Yes.
Also, just as a footnote, there's about as many countries not paying their UN dues, including the US, as there are diplomats not paying their parking fees in New York. So that's not a necessary indication for a weak economy, although I believe the Iranian economy is suffering dreadfully. But
sure.
on that attack, it's interesting because it clearly was, I think, a state-run affair. It took a drone. It was very well targeted. Put an empty ship. That must have this knowledge must have been there before, and it hit the bridge, the command center of the ship. The 2 dead people were the only thing published was that it was a British person and a Romanian person. And I would expect this, knowing a bit of the structure of who works on an oil tanker, this was probably a leading officer or the captain of the ship, plus some security personnel sitting at this control center at the bridge of it. So yes, I would agree with those who say this looks like an escalation, not just an accident. And it looks like Iran, not just some freak band of rebels or pirates. And that fits into the strategy of what Mike has said, that probably it's better to negotiate when you're in hand. But to me, it's more a tit for tat because there was a continuing wave of attacks within Iran, both against material, but more importantly against personnel, most likely carried out by Israel and coming in the wake of Israeli sort of opening relationships with the UAE and Saudi Arabia. And there was the elections in Iran with this hardliner winning. And so what you see is probably a hardline reaction to hardline tactics from around it and an increasing feeling of the wagons being encircled in Iran. And you have to add to that an economy which is performing super dreadfully for all we know. But that's not new. Both bad economic performance and mass protests against it have been quenched before and have not gone anywhere. And I would expect this to continue. So on the oil front, it's not that one should suddenly expect this to be a game of Iranian barrels coming on or not. A lot of them are already on in the market. The capacity has deteriorated a little bit. So we are talking about a few months' time after a deal, and then it ratcheting up first by 600 and then maybe by a little bit of 1 million, give or take. That is something which OPEC policies, with the kind of coordination they have shown so far, can stomach and can deal with. And likewise, Venezuela, Libya are not moving the needle on the supply side. Others, Brazil, Guyana, a little bit, but the big animal, of course, remains shale. To me, it's true that forecasts diverge considerably, but to me, the contours, as I said, become much clearer because we know now from the demand side, it all points to me to sort of the development where you have very high demand throughout this year, and then next year you have a slowing down of oil demand because of slowing down of economic growth and an increase in supplies and a more difficult situation than certainly this fall.
Mike, I'd welcome your views on the point Christof brought up earlier. You touched on it as well. China's demand, China's economic performance, looking like it's moving into a less than expected box. Your thoughts on what's happening there and its outlook for the rest of the year?
Yes, this again falls into the same category as all the other things where the range of expectations diverges massively. I've always been upbeat about China. There is underlying growth, even if it is only 5.5%, 6% as opposed to the trend line. Oil demand growth continues to grow pace as well, but people have been heavily distracted by the latest economic indicators, the ones that the PMI that Christof quoted there before, but also looking at oil demand. And the overlay to all this are the recent measures the government has taken to clamp down on behaviors that it wants to bring in line, and the temporary removal of import quotas for crude oil, or even operating licenses for certain independent manufacturing plants, often referred to as the teapots.
But so even on that, Mike, just to add to that, if I might, also that interventionist position from the Chinese government, even to the extent of like after school nurseries, there does seem to be a period at the moment where the government intervention on the economy is a little more heavy-handed than it has been.
Oh, in many ways, yes. That caused a big ripple in stock markets when they pretty much imposed a sanction on for-profit education organizations, some of which were doing very handsomely, one must add. And of course, then there's also the chopping of tall poppies, as some people call it, in terms of some of the larger entrepreneurs having had their
in particular.
For example. But as with many of these things, if you go back, and I can only speak for the oil side of things, of course, in China, these interventions are often disciplinary measures that don't result in permanent resetting of fundamentals. In other words, those refineries that have been built, of course, they will operate again soon. You're not going to shut a refinery that's been built in the last 15, 20 years forever. You will just impose rules, just as they've done with the imposition of consumption taxes and other measures to get around loopholes, and the very famous fishing bans, which do away with any vessels off the coast that could possibly be involved in illegal movements of petroleum feedstocks and that sort of thing. So I think the underlying demand is there, and it's just a question of how it plays out in terms of inventories. Because they've done another thing in terms of market intervention. They've released oil from stockpile. We believe that the Chinese Strategic Petroleum Reserve will see a draw of 25, 30 million barrels of oil in the fourth quarter of this year, which at some point needs to be replenished because the economy is still growing. So unless you take the view that that stockpile is going to be permanently gone, what it does is it dampens the enthusiasm of the prompt spot markets for the next few months. But in the longer run, one assumes that oil needs to be put back, especially if strategic petroleum reserves are being held for the strategic reason. And I therefore think that we shouldn't make more of these headwinds we're seeing out of China unless we get more definitive stuff on the economic stuff. And those, of course, don't lie. But all the measures, sanctions, and import quotas not being granted, I believe they're more temporary in nature. And Chinese growth is irrepressible. It will continue to point north, and that'll manifest itself in stock draws and ultimately in stronger demand.
Christof, on the point, I mean, the big question of the month, really, of July was the fact that OPEC Plus came to, never mind the quotas for next year, but the production increase 400,000 barrels a day per month from August was seen as lower than the demand required, and hence the tightness and the upward movement in oil price. In retrospect, have OPEC Plus got it right at this number, given the Chinese outlook, the US economy, although boisterous, still below that trend line or of expectation? What are your thoughts on where that sits now, the OPEC Plus decision, given what we're starting to see in the numbers?
I think they certainly have been right to be on the cautious side. I remember how back a few weeks ago, most commentators would say, oh, that's not enough, demand much stronger and all of that. I think that to put these Chinese numbers in perspective, number one, nobody says demand will fall. Everybody knows China, hopes that China will continue to grow, but it does make a substantial difference for one of the last remaining growth centers of oil demand, whether China's economy grows at 6.5% or 5%, a real difference. Number two, yes, they have drawn down their strategic reserves. That comes after years of filling, and they can live with lower levels. And I'd be careful even with the term strategic reserve, because what they have done was they went on a shopping spree when prices were low, a massive shopping spree. And one of the ways to support your economy when it's growing, growth is stuttering, and you have to be wary of fiscal stimulus because your debt levels are rising, your financial system is not as stable as it used to be, is to provide it with cheaper material energy inputs at a time of record commodity prices. That's what they're doing now, and that means that part of the so-called strategic reserve is actually playing with demand at cheaper prices as an economic support measure. All that, plus the financial clampdown, and the fact that the Chinese central bank has increased reserve requirements, points to me that they are wary of slow growth on one side and financial sector problems on the other. And this, of course, fits the Chinese model. Mike is right. They always have a tendency of going 3 steps forward, 2 steps back. But it's also important to note that the 3 steps forward are usually in exports, manufacturing, factory systems, mass production, these kind of things where the infrastructure where they're very good at. And the 2 steps back are usually having to do with banks regulation, with financial market uncertainty, with sort of rather clampdowns on stock markets where they're not so good at. And that's what we are seeing now. So there's an amber sign somewhere here.
Let's just
at the
go
moment,
to this.
demand is held up by the US, but then, as I said, if the contours we are seeing is sort of halfway through, and the US will not be the only bloc in the world steamrolling ahead at record growth rates forever, then we will have a flattening of global demand from 22 onwards. But right now, it's the US which holds it up, and Europe to some extent. And then, of course, we have India and other developing countries about which we haven't talked about. But a true bifurcation.
Let's just go to the survey question on this issue and give the people in the room a chance to express their thoughts on the outlook here for demand. Irene, if we could bring up the survey question, what that looks like. There we go. US GDP number, while robust, fell below 8%. I know it sounds to be a little bit picky, but in large part, I bring that up because so much of the oil price is built into this expected second half demand surge. Should oil demand forecast for the second half of the year be downgraded on these points, including China, etc.? Because we still have that sort of nearly 6 million barrel a day demand recovery this year in most forecasts, and I think that's something to look at. Let's get to Mike and Christof's views. We're the 1st of August, Mike. I know you have your swimming togs packed and ready to go. What is the outlook for the week ahead, the month ahead, do you think, given all of these issues?
I swim every day here, Sean. What does it have ahead? Well, I mean, no question, it's the things I mentioned before. I think let's watch road transport data in places like the US, where you can't apparently find a hotel room for love nor money right now, especially in national parks. Let's look at Asian demand and how Asia, which seems to be peaking on the case count, even in those countries which seem to have a real struggle in controlling things, such as Indonesia. So it looks like the worst news is already beyond us, unless there's another variant that's even more contagious than Delta getting out there. It looks like that's topping out. And most analysts have taken a few 100,000 barrels a day off Asian demand for the months of July and August as a consequence of lockdowns in places like Malaysia, Indonesia, and individual cities such as Brisbane and Ho Chi Minh City, etc. So if all that comes good, that's fine. And then, of course, we have the Saudi OSPs due out towards the end of this coming week. And consensus is that they've been a little on the hawkish side because they've been able to, because, of course, they wanted to mirror the fact that they're withholding supply from market. And there's a view that maybe it's time to start letting loose there. So whilst many people's economic models predict that they can put their Arab Light and Arab Extra Light premium up by 50 cents or more, there's a view that they won't do so, or they ought not do so, in order to not send the wrong message as more OPEC and OPEC plus oil comes into the market, that people opt for the spot barrels that are available on the IFAD and on DME, in the case of Murban and Oman, instead of Saudi grades. And of course, in the week ahead, everyone wants to know, will anyone catch China in the medal table? Since it's
that's a
Olympics.
Good question. But separate from that, and of course, Japan being very much in the center of it, the vaccinations or the surge in infections. But Mike, I wanted to get your views on the consequence, if any, on the relatively low level of vaccinations in Asia, which doesn't seem to be really speeding up in any kind of dramatic way. We saw in Europe, oh yeah, they're going to get it fixed and it's going to surge, and it did. In Asia, we don't seem to have that same narrative. They're going to get it fixed and it's going to surge and we're going to get into the 50-60 percentile of vaccination. Your thoughts, is that the outlook, and what are the consequences of that?
Yes, in Asia you've got Singapore, China, Hong Kong, which are, for all intents and purposes, where the most advanced UK countries are in terms of vaccination progress. But of course they can't do much business with the vaccination rate like that unless they can open their borders, and the neighbouring countries are not quite there. And it's a mix of deficit of vaccines, not ordered enough early enough, but also a rather surprising shunning of the AstraZeneca vaccine, which is astonishing. And I don't want to go too far here and do something that affects the AstraZeneca share price, but I was told by a CEO of a large company in Australia that there was a real publicity campaign against, and many people are waiting for the other one. And if you look at the vaccination statistics for Taiwan and Korea even, they flatlined about a month ago at about 30% and haven't gone up since. And again, that's people having been put off thoroughly by the possibility of side effects of a vaccine that went through stage 3 testing rather quickly. I mean, these things have only been around for 7-8 months. So there is a reticence, a silent minority, which is not small, of people seemingly reluctant to take those vaccines currently available. And then, of course, there's a huge debate about the efficacy of the other vaccines in play, such as Sinovac. And finally, people are worried about the statistics coming out of Europe, where in heavily vaccinated countries, people are getting the virus anyway, and in some cases suffering. And I can say the little sample size that my company offers, there are people elsewhere in Vitol who are vaccinated and who've had to take a day or two off because they got the virus anyway. So vaccine doesn't mean you can't get it. It just means you don't go on an ICU unit in a hospital. So all this is causing the markets to pause here in Asia. And unfortunately, the suppression mindset that most large economies have adopted, be it China, be it Singapore, be it Australia, New Zealand, means that that's impacting trade. The big event we're waiting for is when herd immunity takes root in some countries, as is clearly taking the case in India, and others go to a point of vaccination where travel opens up, because aviation demand in Asia is the laggard, and there's 2.5 million barrels a day of global aviation demand left to unlock. And that's pretty much all of it, because for all intents and purposes, road transport in places like the US and Europe is at or above 2019 levels in many cases. Summer, of course. All the growth is going to come from Asia for the balance of this year. So we have to watch these economies I just spoke about. Sorry,
okay. Let's just get the survey result before giving Christof the last word. Should oil demand forecast for the second half be downgraded? No. Christof, your outlook for the week and month ahead?
Well, end the month. I think the first thing to watch for is growth numbers coming in more on European growth. And then I was looking forward to see all the developing countries, India, Brazil, Indonesia, what the real impact will be in the economic numbers, because the medical numbers are so poorly reported, the case numbers. Secondly, I'm looking at the vaccination situation very keenly. I disagree with Mike. It's not such a simple picture, because what we have in Europe and in the US now seems to be a willingness to open up no matter what happens to the vaccination, to the case rates, because precisely with a high degree of vaccination, hospitalization and fatality rates are going down so much. So you have the US, where cases now are back to 60,000 new cases per day from 12,000 a month ago, but nobody implements a lockdown, so the economy doesn't suffer as it used to. We have the UK with this miracle of case incidences shooting up and then falling down, but still, going ahead with the experiments of complete opening. Even my own family, when I can say so, we will go to the UK hopefully this month, simply because there's no more constraints, no more restrictions, no more isolation, no more quarantine. So, and that seems to be the new model, as Mike says, as long as there's no new, more deadly virus. That it's slow in Asia may have to do with what he said, AstraZeneca, but to me also has to do with the relative ineffectiveness of the Chinese medicine. Infection rates, especially with respect to the Delta virus, seem to be high when you only have the Chinese protection. That seems to be just not good enough in that case. So it's not only having vaccination rates or herd immunity, it's also having the right vaccination rates to protect you. What happens in Europe, where you see numbers going up of the infection rates, not the fatality rates, is actually mostly young people who seem to be more susceptible to this Delta virus and who are not vaccinated. Otherwise, it plays itself out. I still think we are seeing the end of the pandemic in the sense that we learn how to live with it without major clampdowns. We're seeing the beginning of that now, and we will not have the same kind of winter which we had last year.
Yeah, it certainly is the question mark as to where, I mean, I say August because obviously it is typically holiday season in the Western world, and then what happens after all of that mingling when we go back to school. So there's still, I think, a dynamic of this Delta variant to play out that hasn't really hit the wall yet in terms of its impact. But we're going to have to leave it there. We're on all week, but we will, like most, take a break for the next week and the two weeks after for the season, and hopefully everybody will get a bit of a time out. But Christof, as always, thank you very much. If we don't talk to you, just talk to you at the other side of the break, and really appreciate your insights. Mike, as always, have a great August. We'll catch up with you in early September, and everybody else will be here tomorrow morning, 10:30 UAE time. Thank you so much. All the best.
Thank you. Have a great month.
Christof, enjoy the UK.
Yeah, we'll try. That would be